What if you could uncover the exact methods that turned Warren Buffett from a small-town boy with a few dollars into one of the richest investors in history? From his early mistakes to the strategies that made him billions, Warren Buffett mastered a simple yet powerful way of thinking about money and the market. And in this summary of the Warren Buffett way, we will cover what led him to beat the market over and over again. First, let's rewind the clock to when Warren Buffett was just 11 years old. Armed with $120 he had saved from selling soda and peanuts, he decided to buy his first stocks. He studied the price charts, made his purchase, and then bam! The stocks dipped, losing value almost instantly. When they finally crept up to a price slightly above what he paid, he panicked and sold, taking a small profit. Just a few days later, those same stocks skyrocketed, leaving him to reflect on what could have been. This early move taught him two crucial lessons. Number one, never obsess over the price you paid for a stock. And number two, never sell for anything less than a substantial gain. These lessons stuck with him like glue, and so Buffett went on to pursue a relentless education, graduating from college and hustling for a spot at Graham-Newman Corporation, a place where he would truly learn the ropes of the investment world. At just 25, he started his own limited partnership with a modest $100 investment, setting a simple goal: beat the Dow Jones by 10% a year. What happened next was a feat that turned heads. He didn't just meet that goal, he doubled it, growing his fund to $25 million in 12 years. This was only the beginning though. Buffett saw an opportunity in a struggling textile firm, Berkshire Hathaway. He decided to buy it. This choice would shape his life forever. He took a leap and invested not just in textiles, but in companies with solid foundations and steady growth prospects. From that first $100 investment to building a multi-billion-dollar empire, his path wasn't paved with luck or privilege. It was about learning, applying those lessons, and making bold yet calculated decisions. And this is just the start of how he redefined the game of investing. So how did he do it, and what makes his method so unique? Well, we need to understand that Buffett didn't become a legendary investor overnight. His education extended beyond books and classrooms. It was shaped by two influential figures who changed his perspective on investing forever. The first of these figures was Benjamin Graham, a mentor who taught Buffett the core principles of value investing. Graham was the author of Security Analysis and The Intelligent Investor, two seminal works that laid the groundwork for modern investment strategies. Graham had one simple rule: don't lose. He sought companies selling for under 2/3 of their true value. They should also have a low price-to-earnings ratio. He believed these were signs of a good investment. This meticulous focus on undervalued stocks deeply influenced Buffett. He learned to dig deep into research and identify investments that the market had overlooked or misunderstood. Graham's teachings gave him a solid foundation and a strategy that would guide his early years as an investor. Then came Philip Fisher, another key influence who introduced a new dimension to Buffett's thinking. Unlike Graham, Fisher wasn't just looking for bargains. He focused on buying high-quality businesses. He believed that a great company, even if not a bargain at the moment, could grow and outperform the market over time. Fisher stressed the need for strong management, innovation, and long-term growth. This idea intrigued Buffett and eventually led him to evolve his strategy. And then there was Charlie Munger, a sharp, independent thinker who would become Buffett's closest business partner. Munger had studied law, but his passion for investing led him to cross paths with Buffett. Munger was inspired by Fisher's philosophy of investing in quality, and he convinced Buffett to rethink his methods. For instance, when Munger suggested buying See's Candies, Buffett hesitated. It was known for its quality, but it wasn't a bargain. But Munger's reasoning was clear. The company had a superior product and a loyal customer base. So it was an outstanding business worth owning, even at full price. So Buffett agreed to take the leap, and See's Candies became one of Berkshire Hathaway's first great successes. Within 10 years, the value of the company soared far beyond its purchase price, and Buffett decided it was too good to sell. Now, let me break it down to you. See's Candies wasn't just a profitable investment. It was a turning point that cemented Buffett's belief in combining Graham's principles of value investing with Fisher's emphasis on quality. So now, Buffett's education wasn't confined to just one philosophy or approach. He took the best from both Graham and Fisher. He blended them into a strategy that sought strong companies with good management, growth potential, and fair prices. This mix helped him spot opportunities others missed. He built a portfolio that became the envy of the investment world. As he continued to grow his empire, he refined his methods, constantly learning and adapting to stay ahead. So, what exactly does he look for in an investment, and how does he decide which companies are worth his time and money? When Warren Buffett considers buying a company, he doesn't just skim the surface. He follows a set of principles, almost like a checklist, that guides every decision he makes. These are his 12 tenets, the criteria he uses to determine if a business is worth his investment. Let's break them down. First, he looks for 3 key business characteristics. The company should be simple and easy to understand. Buffett likes to invest within his circle of competence, sticking to industries and businesses he knows well. Next, the company needs a consistent operating history. No surprises, no wild swings. He wants to see stability and a track record that proves the business can perform well over time. And finally, there should be a favorable long-term outlook. Buffett isn't interested in a quick win. He looks for companies that will thrive for decades, not just a few years. Then comes the management aspect, something Buffett values immensely. He digs deep to understand who's running the show. There are 3 things he's looking for in a leadership team. First, he wants managers who handle finances rationally, making smart decisions that benefit shareholders and the business alike. He then looks for leaders who are candid and transparent with their shareholders. He values honesty and expects the management to communicate openly, especially when things don't go as planned. Finally, he seeks independent thinkers. They must be willing to make tough decisions, even if they go against popular opinion or industry norms. But that's not all. When it comes to numbers, Buffett is meticulous. He analyzes 4 financial factors to ensure the company is financially healthy and capable of growth. He starts by looking at the return on equity, which shows how effectively a company is generating profits from shareholders' money. Next, he examines owner earnings. He prefers it over cash flow. It accounts for maintenance costs and shows true profitability. He's keen on high profit margins too, as they indicate a company's ability to control costs while maximizing revenue. Lastly, he checks the market value to see if it's steadily increasing, a sign that the company is growing in its industry and appealing to investors. The last 2 considerations are straightforward but crucial. First, is the company a good value? This doesn't necessarily mean cheap, it means worth it. He looks for companies that are worth more than they cost. This could be due to growth potential, strong brands, or solid fundamentals. And second, is the price right? Even if a company is outstanding, Buffett wants to buy it at a price that makes sense. He's not in the habit of overpaying, no matter how great the company is. All these factors come together to form Buffett's unique buying guide. It's not about following the crowd or trends. It's about finding great businesses led by capable people that can deliver solid returns for years to come. And it's evident. These principles have helped Buffett build a portfolio that others can only dream of. But investing isn't just about numbers and criteria. It's also about understanding the emotional ups and downs of the market itself. So how does Buffett stay calm and rational, even when the market seems to be losing its mind? Investing isn't just about numbers and spreadsheets, it also involves emotions, decisions, and the psychology behind them. Warren Buffett often talks about Mr. Market, a fictional character created by his mentor, Benjamin Graham, to personify the erratic behavior of the stock market. Mr. Market is your business partner, offering to buy your shares or sell you his every single day. But there's a twist. Mr. Market is moody, unpredictable, and swings wildly between extremes. One day he's euphoric and sees a bright future, willing to buy your shares at sky-high prices. The next day, he's gloomy, convinced the end is near, and offers them to you at rock-bottom prices. Buffett believes the trick is to see Mr. Market for what he is, an emotional roller coaster you don't have to ride. Instead of being swayed by his highs and lows, Buffett advises investors to stay calm and rational. He knows that market movements are often driven by fear, greed, and speculation rather than facts. His approach is to focus on the true value of a business and ignore the daily mood swings of Mr. Market. But keeping emotions in check isn't always easy. The field of behavioral finance studies these psychological traps that many investors fall into. One common pitfall is overconfidence, believing that you know more than you do, leading to rash decisions. Then there's loss aversion, where the fear of losing money can cloud judgment, prompting hasty selling when the market drops. Following the crowd, known as the lemming effect, can also be dangerous. It's tempting to follow others when everyone seems to be making a move, but it often leads to poor investment choices. Buffett is also wary of overreaction bias, seeing patterns where none exist. A few random events can be mistaken for a trend, pushing investors to make decisions based on short-term noise rather than long-term value. Then there's the concept of mental accounting, where people treat money differently depending on its source. Found a $20 bill? It feels like a bonus, tempting you to spend it carelessly, forgetting it's just money that could be put to better use. And finally, there's myopic loss aversion. It means fearing losses so much that you check your stocks too often and panic over short-term dips. Studies show that the longer you hold an investment without constantly evaluating it, the more attractive it becomes. Buffett practices patience here, knowing that the market will have its ups and downs, but good investments pay off in the long run. The market is driven by more emotion than reason, which is why understanding these psychological traps is so crucial. Buffett stays focused on the value of his investments, unaffected by Mr. Market's mood swings. His approach requires discipline, self-control, and the ability to tune out the noise. And while most investors get caught up in the daily drama, Buffett remains steady, waiting for the right opportunities. So how does Buffett manage to stay so calm and collected when others are losing their heads? It comes down to two key qualities. Buffett often says his success has less to do with intelligence and more with patience and a calm, rational mindset. Unlike most investors who get caught up in the market's daily chaos, Buffett takes a different approach. He plays the long game. He understands that big returns aren't about quick wins, but about holding strong positions over time, even when the ride gets bumpy. Buffett's strategy relies heavily on what psychologists call System 2 thinking, the slower, more deliberate type of thinking that requires careful reflection and good judgment. He avoids gut decisions. Instead, he takes his time. He digs into a company's fundamentals. He analyzes its growth, its competition, and its management. He knows this thinking requires discipline and isn't always comfortable. But he trusts the process. It leads to better decisions over time. Research backs this up. A study looking at the S&P stocks over 43 years found that while only a small percentage of stocks doubled in value in a single year, the numbers grew significantly over longer periods. For stocks held over 3 years, a much higher percentage saw significant growth, and over 5 years, the numbers increased even more. This shows that the longer you hold an investment, the better your chances for significant returns. Buffett's patience aligns perfectly with this finding. He knows that great investments need time to mature and deliver. He also talks about avoiding the mind-wear gap, the difference between what we know we should do and what we actually do. Most investors know they should do thorough research, read annual reports, and study a company's competitors, but they often skip these steps in favor of quick wins. Buffett, however, dives into the details, from assessing capital allocation strategies to talking to people inside and outside the company. He never rushes. He stays curious and thorough, always looking for that deeper understanding that gives him confidence in his decisions. This is also about self-control. He knows that staying rational in investing isn't just about understanding numbers, rather about managing emotions. He doesn't let excitement over a hot stock tip sway him, nor does he panic when the market drops. Instead, he stays grounded, keeping his focus on the long-term potential of his investments. So the two key qualities Buffett's secret sauce to outperform everyone else are patience and rational thinking. Because this patience and rationality allow him to avoid costly mistakes that come from acting on impulse. Remember, while many chase the next big trend or try to time the market, Buffett remains steady, playing by his own rules. Even someone as powerful and rich as Warren Buffett can come from humble beginnings. Buffett himself believes that anyone who follows the same rules can repeat his seemingly impossible success. Do you believe Buffett's principles of patience, rationality, and focusing on long-term value are the keys to beating the market? Or do you have a different take on what you really need to succeed in investing? Share your thoughts in the comments below and be sure to subscribe.